So today we'll be looking at um, three major content, or let me say up to four out of these items. And basically, the content of this training would contain introduction and legal basis for company income tax in Nigeria. We'll be looking at determination of adjusted profit. What are the things to look out for when you are determining your adjusted profit? We're looking at basis period for company income tax purpose, right? We'll also be looking at capital allowance computation, how to determine what your capital allowance rate should be. We'll be looking at determination of taxable profits, right? Also determination of education tax. So this one is just like, since it is part of the CIT computation itself, I just thought that okay, it would be good that I include it in this training also. So we'll also be having the compliance requirements. What are the filing requirements? What are you supposed to file your CIT? How much are you supposed to pay? What are the modules or filing steps required for tax promax? And then finally, we'll be looking at how to prepare for tax audits, right? That relates to company income tax and education tax in Nigeria. Right. So let's go straight into the first section. The first section is talking about the introduction and legal basis, right? And in this introduction and legal basis, we'll be looking at definition of terms, what are the legal and regulatory frameworks, and then what is rate of tax for company income tax and probably education tax. Right. So this I want us to know that the legal basis for determination here that we're looking at is a very important guideline, or let me say, it's a very important aspect of this training. Understanding the legal basis is a very important aspect of this training, so that beyond the simple examples that we'll be doing in the class and maybe some other technical questions that we'll be asking in the class, subsequently after this training, you can go out there and prepare your tax computation confidently, even for other companies, right? Not just a practical demo that we do in the class. You can confidently go and do it for other companies. And so that's why I would like us to just pay attention to the training material, to the terms that we'll be defining, what are the key things that you need to watch out for during the course of this training. So definition of terms, look at legal and regulatory framework and rate of tax. So we'll go to the first item, definition of terms. So I know many of us are familiar with some of these things, but let's just allow it to sink, right? So that we can all learn together. So definition of terms. First of all, we have the terminologies, which I have put to the left, and then we have the definition. So accounting year. So an accounting year, right, or financial year is a 12-month operational period at the end of which a
Hello?
company prepares its financial statement.
Ah, you are at home now.
Hello, Modico, I think you can
Okay.
mute yourself. Thank you. So accounting year, this is the period of 12 months. Of course, I know that most of us here are accountants, so we are familiar with some of these terminologies, right? But just let's just take note for tax purpose what these definitions mean. So accounting year is the period of 12 months, that is operational period where the accounting period is being prepared up to 12 calendar months. So we have January to December, we have April to March 2025. So you can have it like that, depending on the period. You can have the accounting year interpolate between two years. That is, for example, April 2014 to March 2015. You can also have it as 12 calendar months. You can also have it as 12 calendar months. So yeah, moving on to the next one, I have accounting date. So this is the date in which the accounting period ends. This is the date in which the accounting period ends. All right. So okay, read one. You are the one behind the other module, right?
Yes, I'm the one.
All right, thank you. Thank you. I was trying to confirm who was there before so that the person can help with the recording. So
Okay.
that's
Yeah.
so maybe please you will help me with tracking the recording. Maybe I'll just once in a while I'll let you to know so that I don't want the recording to be too long before we break it.
Okay.
Yeah, thank you. Okay, so basis period. This is the period for which a taxpayer's income is being assessed to tax, right? When you say basis period, why do we talk about basis period? Don't worry, subsequently we'll discuss examples of basis period so that you guys can know how to compute basis period. But this one is just definition of terms. So it is the period, right, in which the taxpayer's income is being accessed to tax, right? And then, like I've put it here, it is the basis upon which tax liability will be computed. And under the tax system in Nigeria, we have what we call the actual year basis, we have the normal year basis, and we have the preceding year basis. So actual year basis, normal year basis, preceding year basis. These are further defined under this definition of terms. So now, what is the year of assessment? This is also known as the tax year, and it is the year in which the taxpayer is being assessed to tax. So don't worry, I don't want to give you the full definition since I have it stated here already. So year of assessment is the year that you will eventually be taxed. So let's say if your accounting year end is 31st of December now, right? If it's an ongoing business, your year of assessment will be the subsequent year. So if it's 2023, for example, that your account, let's say January to December 2023, that's your accounting year, and your year end is December. See, I'm already using all the terms. So accounting year, January to December 2023, your year end, 31st of December. Now, the basis period, okay, we'll still get to that aspect, right? But this year of assessment now that we are in, the year of assessment will now be depending on the nature of the business. Is it a commencement? Is it change in accounting date? Is it an ongoing business? Or you understand? So when it is an ongoing business, so your year of assessment will be the preceding year, at least preceding year basis, meaning that if we're in 2023, my tax for 2023 will be paid in 2024. So 2024 becomes my year of assessment. All right. So we also have what we call the capital allowances. So capital allowance are type of tax relief for businesses. So these are deductions that you enjoy for incurring capital expenditure, um, which the depreciation on such capital expenditure is being disallowed, right? So actual year basis, yeah, actual year basis, this is the basis of assessment which coincides with the year of government year of accounting, of course, running from January to December 2020 of that particular year, right? So I gave an instance here. The accounting year end of a company, 31st of December 2012, 2016. What will be the corresponding tax year on actual year basis? So I'm asking that question now. So what will be the corresponding tax on actual year basis, tax year? Anybody? For a company that has 31st of December 2016 as its accounting year end, what will be the year of assessment? What's happening now?
I know.
I,
Sorry, Richard. Hello.
yeah,
Hear me?
I
I
can
said,
hear you.
yeah. I don't know if I also have access to answer question or I will just be come on a spectator here.
Okay, I'll give you the grace to answer questions. Okay, I think
Okay.
I'm trying to just follow up my chat and then,
Okay.
yes, the session is being recorded. So people that are asking me questions around being recorded, yes, the session is being recorded. So you definitely have access to it. Okay, so you can go ahead, read one.
Okay. When you say year of assessment, it used to be on preceding year basis, so it should be 2017.
2017. Okay. Now, don't forget, under the actual year basis now. So what will be the year of assessment under the actual year basis?
Actual year basis, it will be in 2016. That's same year.
Yes, the same year. So that's what I'm just trying to clear out there so that people that are on the call. So let me just assume that you guys do not know it. So when we get to the part where we are going to be doing the calculation, right? There will be practical demonstration of how the actual year basis, preceding year basis, normal year basis is being calculated, right? Prior to Finance Act 2019 and then sequel to the advent of the Finance Act also. So preceding year basis period, this is where the tax year, or that is the year of assessment, would be a year after the accounting year end, a year after the year end of the company, accounting year end of the company. So let's say if your company's year end is 31st of December 1990, what will be the preceding year basis? What will be the year of assessment under the preceding year basis? Let me allow Tijani to go. Tijani, are you still on the call? Hello, TJ, are you on the call? Okay. So let me give you guys an hint,
Oh,
right? Okay, TJ, you're back, right? Can you hear me?
dang.
I want to know. I want you guys. You know that this is a paid session, so I would like it to be as interactive as possible. Even though I know the recordings will be made available, but let's interact. Let's ask questions. This is where we get to also learn these aspects that we are trying to know, right? So let me just rephrase it again. The preceding year basis. This is the year after the accounting year end in which the company is being subject to tax, right? So it is also known as the year after the accounting year end. That's the preceding year basis, meaning that the tax for this year will be taxed next year. Sorry, the profit for this year rather will be taxed next year. So that is what we call the preceding year basis. So let me quickly run through the definition so that we don't waste much time there. Once we are done with this definition part, we would stop the recording and then proceed to the next session. So we have the terminologies also, normal accounting basis. So of course, this is synonymous with an ongoing business and has the following features. So it must be a period of 12 months. That's the normal accounting period basis. It must commence immediately after the end of the previous accounting year. That is, if your accounting year is January to December, the next accounting year must be January to December also. So that is the consistency in normal year basis. Moving on to the next one, it must be only accounting year end in the year of assessment. It must be the only accounting year end in the year of assessment. So that is, there must be no combination, there must be no overlapping period in between. So it must be the normal 12 calendar months accounting year end, right? So we also have the abnormal accounting or basis period. So this is the opposite of normal accounting period. So this one usually occurs in commencement, change in accounting days, and sedation, where you have overlapping periods, right? Then we also have profit before tax. Many of us will be familiar with this by now. So this represents accounting profit recognized on the company's financial statement before it is being subject to tax, right? This is the profit that the company makes before tax is being applied on that profit. So you have, sometimes you see it called operating profit, or you see it called as so after you have your gross profit, take out your administrative expense, add back your finance income, take out finance cost. That profit that you have before the tax, that is what we call the profit before tax, right? Then we also have what we call the accessible profit. So this accessible profit represents profit arrived after tax adjustment. So after the adjustment for tax purpose, that's what we have the accessible profit. Okay. So education tax, of course, education tax is being charged on this accessible profit. Then we also have taxable profit. Taxable profit, this represents amount for the tax rate. That is, this taxable profit is the amount in which your tax rate is being applied on. So it represents the amount for tax rate for which tax rate is being applied on to arrive at your taxable or tax payable. So let's take for example, after you have done your under your company income tax computation, we have the profit before tax at the first item. You add back disallowable expenses, take out allowable income, right? Then you take out your losses, take out your capital allowances, if any. Then you have what we call the taxable profit. The taxable profit is what you now subject to CIT at maybe 30%, 20%, or 0%, as the case may be, right? And we now have, after you have now subject your taxable profits to CIT, then you have what we call the company income tax payable. Now, for the purpose of reporting taxes, right, the government always like to have comparison. So they have what we call the minimum tax also, right? Okay. So minimum tax. I'm trying to just juggle. I know we are supposed to be more than this. I'm trying to just some of them are some of the participants are messaging me. So I'm trying to just make sure that I attend to everybody's request. So minimum tax. This is the lowest amount of tax payable by any company in Nigeria. So minimum tax is just like a form of comparison that the government has put in place that okay, so if your computed CIT based on your normal PBT, less allowable expense and all those things, when your computed CIT is lower than minimum tax, the minimum tax will prevail. Don't worry, as we go on, all these things might be like technical jargon to you for now, but as we move on, you understand better. So your minimum tax is the lowest amount of tax that the government expects you to pay, right? And you have to do some comparison to be able to arrive at your minimum tax. Currently, minimum tax is charged at 0.5%, right, of your total of what we call the gross income, 0.5% of your gross income. And there's a definition to that gross income. So when we get there, we'll cross that bridge also. So we also have what we call the excess dividend tax. So this is tax payable based on Section 19 of CITA, right? It provides that where a dividend is paid out of profit and the dividend paid is greater than the taxable profit, tax should be paid on the differential at the rate of 30%. So you can do either ways. You can either apply your dividend, 30% of dividend, right? Or 30% of your CIT, whichever is higher. So if you have done 30% of the dividend is higher, then that means your tax should be paid on your dividend. If you have done 30% of CIT, that means your tax should be paid on your CIT. Whichever is higher is what the government recommend that you should pay. So you have to now compare the minimum tax, CIT based on minimum tax, CIT based on excess dividend, and then CIT based on normal taxable profit. Whichever is higher, that is what the government recommends that you should pay, right? So we'll quickly stop this recording aspect and then we are able to move to the next section under this table one. All right. Just a minute.